Welcome to another episode of Unpacking Transfer Pricing series. Today, we will discuss Chapter 8, Cost Contribution Arrangements of the OECD Transfer Pricing Guidelines 2022. This isn't professional advice, and for specific situations, one should always reach out to actual transfer pricing consultants. Think of this as your basic general knowledge. A link to a detailed audio-only description is available in the comment section below. So, let's start. Cost Contribution Arrangements, CCAs, are contractual arrangements among businesses for joint development or production of intangibles and services. They involve sharing contributions and risks without forming a distinct juridical entity. CCAs simplify transactions, allowing participants to exploit outcomes individually without additional payments, enhancing efficiency and collaboration in business operations. CCAs create benefits for individual businesses, allowing them to exploit outcomes without additional payments, thus simplifying multiple transactions. Development CCAs focus on joint development of intangibles, offering future benefits with significant risks, often seen in research and development projects. For instance, a multinational group may share research and development activities for production improvements. Services CCAs, on the other hand, provide current benefits with less risk, commonly used for back-office functions like shared administrative services across group entities. CCA is a contractual framework where participants share contributions and risks, aiming for mutual benefits. It doesn't require a distinct juridical entity. Participants share risks and rewards, gaining ownership interests in resulting assets or services. CCAs simplify transactions, replacing complex cross-licensing. For example, enterprises collaborate on research and development for production improvements, pooling expertise and sharing risks, rather than doing entire process individually, thereby consuming more resource, time, and leading to duplication. The OECD guidelines provide a comprehensive framework for CCAs, emphasizing risk allocation, intangibles valuation, and intragroup services. Though Chapter 8 focuses on cost contribution arrangements, it does echo in Chapter 1 outlines general principles, including risk analysis. Chapter 6 addresses intangibles, crucial for arm's-length conditions, and Chapter 7 guides on intragroup services. Multinational enterprises must adhere to these guidelines to ensure compliance with the arm's-length principle. To satisfy the arm's-length principle in CCAs, participants' contributions must align with what independent enterprises would agree upon. Each participant should expect mutual benefits, and contributions must be calculated and allocated proportionately. Recognize uncertainties in profit statements across jurisdictions, and maintain documentation to substantiate claims. These principles apply to both development and services CCAs. To qualify as a CCA participant, entities must have a reasonable expectation of benefits and be assigned rights and results. They must control specific risks and have the financial capacity to assume them, a concept which we got familiar with in previous chapters and especially while understanding DEMPI. For instance, a research provider performing research and development without receiving interest in developed intangibles is not a participant, but a service provider. Estimating expected benefits from CCAs involves analyzing anticipated income or cost savings. Common allocation keys include sales, profits, units used, and number of employees. Multi-activity cost contribution arrangements may require multiple keys. Challenges arise with future benefit projections due to verification difficulties and potential variances from actual results, necessitating periodic adjustments and consideration of hard-to-value intangibles guidance. CCAs should be valued at their true value, considering both pre-existing and current contributions. Development CCAs often use cost measurement, while mixed contributions require consistent valuation. Budgeted costs can be practical, and shared property needs proportionate allocation. Ensure contributions reflect the expected benefits for each participant, adjusting for jurisdictional differences. Balancing payments adjust contributions to align with expected benefits. For instance, if Company A expects 75% benefits but initially contributes 10 million euros, while Company B expects 25% benefits with a 6 million euro contribution. A 2 million euro payment from A to B adjusts their contributions to 12 million euros and 4 million euros, respectively. These adjustments are anticipated at CCA entry and periodically re-evaluated. Consider a CCA with 3 production sites sharing R&D expertise, resulting in a streamlined system. In a joint development of intangibles, companies A and B split benefits 75% and 25% based on sales. In a mixed, contributions involve pre-existing technology and current R&D services. Determining the value of each contribution is key. Now, if Company A's contribution equates to 10 million euro and Company B's contribution equates to 6 million euro, in order to achieve 75% to 25% ratio of benefit, Company A will have to make a balancing payment of 2 million euro to Company B. Always ensure detailed CCA documentation for transparency. CCA are treated as if made outside the CCA, meaning to a third party, thereby adhering to general tax rules. The character of these contributions is determined by domestic laws and treaties. Services CCAs often result in cost savings without direct income, while development CCAs may delay benefit accrual. Balancing payments adjust contributions, increasing the payer's and reducing the recipient's share. CCA membership changes involve participant entry, withdrawal, and termination. Entry requires previous participants to transfer interests, while withdrawal may include work in progress. Termination is based on contribution shares. Tax treatment of buy-in, buyout, and balancing payments follows general tax rules, ensuring arm's-length value for compensation. Participants retain proportionate interests, adjusted for contributions and balancing payments. It is advisable to consult tax practitioner for local rules and regulations surrounding CCA. Comprehensive documentation is crucial for CCAs to uphold the arm's-length principle. Initial terms must detail participants, scope, duration, and benefit allocation. Valuation documentation should cover initial contributions and adjustments. Ongoing reporting requires updates on arrangement changes, projections versus actual results, and annual expenditures. Taxpayers must be ready to provide this documentation to tax administrations. That's all for this episode of Unpacking Transfer Pricing. Remember, this podcast provides high-level understanding only. Transfer pricing is a complex field, and for any specific business decisions or compliance, you should always seek professional advice from qualified transfer pricing consultants. Do not rely on this information as professional advice. Join us next time as we delve into another fascinating area of transfer pricing. Until then, keep learning.